So I thought, wait for the bubbles. What's up, everybody? Welcome to our periodic frequent fusion spaces. We've got another awesome group of folks here to jam on topics about RWAs, the intersection of DeFi and TradFi, all sorts of interesting stuff happening. I think that as a segment and category, RWAs are talked about a lot. There's lots of metrics that people focus on that really kind of don't matter. So I think that's an interesting thing. Like, just because you have an issuance of something like a money market fund on chain doesn't really make it better than if it was just off chain. So I think that from a metrics perspective, there's lots of interesting things to unpack. Just for everybody who's listening in, to remind you, Fusion is a sub-ecosystem built within Avalanche, backed by a $100 million commitment from the Avalanche Foundation. The Fusion is very different from other ecosystems because we're focused on basically using blockchain as a back end to deliver services that really matter in like real world outcomes. So not just here to have things settle on chain. It's how do you have better agentic payments through Kite AI, or how do you have better healthcare AI through Life AI, or how do you have programmable finance through W3? So it's Fusion is an ecosystem of different verticals. So there's different vertical leads. Each one of those vertical leads basically is responsible for pulling together an ecosystem that runs on a blockchain backend but doesn't sell block space. We sell access to outcomes. So that's agentic payments, programmable finance, so on and so forth. We're about we had our year birthday a couple months ago. G and I thought this concept up in January of last year, made a lot of progress. Kite AI launched, it's doing very, very well. Token prices and everything, but it's in the top 100 right now. We've got a bunch of other ones that are coming in the queue. So things are good. We like to focus on real topics that matter. We don't build on chain just to build on chain. We build on chain because it results in better businesses. And that's Avalanche's focus, and that's also the focus of Fusion here. We try to find the best founders, best projects, building things that matter, leverage Web3 rails, incorporate things like RWAs and stablecoins and payments. So we got Jose on, who's at a payments for Avalanche, so I think we're gonna have interesting conversations on that topic. But if you've been attending this series, we tend to talk about real things, important things. It's a great time to be building it within Web3. The fact that a lot of people are exiting is fine for me. No problem at all. Just leaves more opportunities for the rest of us. Two important things are happening. One, and I think most germane to this conversation, is it's becoming clear that blockchain rails are just better. And I think we have Karn, who's the CEO of Re. He can talk about how that's impacting his business, which I think is happening in really interesting ways. That's going to make them a lot more competitive and be able to grow revenue compared to legacy businesses. And then we've talked about this on previous threads before, and Karn and I talked about this quite a bit. It's the intersection of a token and a revenue producing business. This hasn't really, there's a couple out there like Hyperliquid, but how do you have a token? Because a token is basically a capital formation vehicle. And how does that interact with a revenue producing business? There hasn't been very many of them. I think it's been fairly limited to some in DeFi. Most of the DeFi tokens aren't actually connected to the core revenue engine though. I think Hyperliquid is the big exception. So I've given a longer than normal overview and intro. So instead of me blabbing, why don't we introduce the panelists and then we'll start asking some questions. So brief overview, who you are, what you're building. We'll start with you, Karn.
Hey, first of all, thanks for hosting us and giving us an opportunity to talk about what we're building, and that dovetails into Avalanche more broadly. I'm CEO of Re. We are an on-chain reinsurer. We take in stablecoins into a global capital lake that's observable by anybody with a computer, and certainly every insurance regulator and insurance counterparty in the world. We deploy those stables into insurance companies across the United States, enabling them to go write insurance business of just about anything you can imagine. But we focused on kind of the plain bread and butter stuff: auto, home, small business, commercial, workers' compensation. Back 35 insurers. We do about 350 million business. We're the first and currently only scaling reinsurance entity on chain. So that's us.
Fully regulated for everybody. They got all the. This is like it's a regulated business operating on chain, which is very cool and I think unique. And we'll dig into this deeper. Karn and team are doing some great work. Ray, intro.
Hey, GM, great to be here with you all. Ray Buckton, I'm starting Framework Labs. Framework Labs is a credibly neutral advisory focused specifically on risk and compliance in Web3. So we focus on things like smart contract architecture, regulatory reporting, and help risk and compliance officers make sense of all this wonky on-chain stuff. And then, of course, we help teams that are going to be interfacing with regulatory and compliance entities make sense of what they need to actually bring to market to check the boxes. So great to be here.
All right, G.
I'm Giancarlo Roma. In these streams, if you've seen them before, I usually introduce myself as a strategy architect. It's not my official job title. I wish it were because it sounds very cool. But realistically, I help run the team. I do, high-level strategy, help with deals to bring in interesting projects to the ecosystem, and also, as David mentioned, one of, I guess you'd call the founding fathers of the Fusion initiative.
Yep. Jose.
Nice to meet you all.
Thanks for Vegas, man. Good to see you.
I'm sorry, what was that?
A while since we saw each other in Vegas, so good to see you again.
For sure, man. Yeah, likewise. So yeah, I'm Jose Nuno. I'm effectively leading all things payments here at Aave Labs. Joined last October, so relatively newer to the team, but come with a background of 20 years in what you would call traditional payments. I tell folks I'm a masochist because I wanted to jump headfirst into the crypto space after leading a few crypto initiatives at these payments companies. And then most recently, I've been working kind of in the payments and crypto adjacent space, notably at a couple different on-ramps providers. Known the team here at Aave Labs now for 5 years, worked on a couple different projects. Being that my background is in payments and right at the intersection of where payments and crypto collide, I'm here to bring all that together and lead any of these use cases that we're seeing in the industry now with the proliferation of stablecoins and effectively making it better money. We're looking at all the different projects and ways to expand on what we're seeing across the board when it comes to on-chain payments.
Cool. All right, so let's go back to Karn at the starting point. So, we've talked a lot about on this series about building better businesses on chain. Why is Re a better business because it's built on chain versus how reinsurance businesses are currently operated?
Yeah, sure. Look, I spent 7 years building an insurance company prior to this, and so I developed a pretty good appreciation for the work that's done, the value that's created, and the value that's extracted by each of the intermediaries within the insurance value chain. Not too different from other financial services verticals, payments specifically. It's pretty intermediated. This as a starting point is an opportunity and a first thrust at disintermediation. Ultimately, if you think about what our product is, it's a promise to pay, a couple of proof that you can pay. It can be that simple. You can memorialize that product on chain. You can make sure the people who need the coverage have it accurately reflected in the public domain. Part of the product is not just like making sure that you're protected, it's also proving to other people that you are protected, right? As part of an interaction or a commercial interaction with them. And we thought that the most elegant way to do that would be on chain. Now we're kind of, we're uniquely in this unique moment of time where that kind of verifiability, the ability to collect the capital to fulfill the promise is being coupled with the ability to underwrite and price the business agentically. So these two things are kind of coming together nicely. It's not even something that we foresaw, but the optionality in the business is kind of continuing to go up. So like, why would you do anything like this? Like it's a $1 trillion market with participants that write, near 100 billion in premium at the top end a piece. We have now the opportunity to build an incredibly high operating leverage business with a couple dozen people running $1 billion run rate business, and the ability to connect into an asset market that is desperately looking for a real source of uncorrelated yield, right? Real economic activity is driving every dollar of value accrual to folks who are staking their assets to RE. And so seemed like a directionally correct bet, partly predicated on kind of just being in the business for a long time and understanding how these things could stitch together and inferring that this was the path forward. So we're 11 people, we could run a multi-billion-dollar book of insurance business. We could back hundreds, if not thousands, of insurance companies across the world, in pretty short order. And I don't think that would have been possible if we were simply spinning ourselves up as a traditional reinsurer out the gate.
And the reasons why are because, less friction in terms of bringing on capital. What are the reasons why? And tell people what type of yield you typically generate. You can show yourself a little bit here. It's okay.
Sure. Yeah. So, I mean, all of our counterparties are admitted insurance companies in the United States. So part of it is kind of like, this is a difficult business to execute. You got to convince regulators, you got to convince insurance companies, you got to convince DeFi capital. And the sequence has been convince regulators, convince the customers, use our own capital, kind of bootstrap it, and then bring in DeFi capital because it's the most skeptical and the most flighty. The perpetual advantage here is like, hey, if we have these, you literally put in stables, you receive a depository token. The depository token is useful in broader DeFi. As it proliferates through broader DeFi, it picks up utility. It's embedded in more lend markets. It gets embedded in interest rate speculation markets. Starts making its way into vaults. It becomes like a real fixture of everything else that's going on in DeFi. Creates a stickiness and a utility that the surplus or the capital that's tied up in an insurance company or a bank currently can't do. Right. And so, if you couple that with complete transparency around the risks to your party to how much capital you have, trust begets, this transparency begets trust begets liquidity begets a lower cost of capital over time. And that is a structural advantage. It just cannot be replicated by anyone who's trying to raise money into a centralized vehicle. And we're relying on a financial rating to kind of move forward. And so it becomes a critical piece of financial infrastructure. It's like the substrate for all economic activity. Now it's distributed amongst all of DeFi, which I think is a pretty critical differentiator. The second part, the operating leverage piece, right? I think it's not just DeFi. It's like we're talking about a time now where a couple dozen people can replace the works of hundreds of people. So long you have sufficient domain expertise and you understand how like the business works and the software is intended to work. That is both AI and the ability to kind of tap the capital on chain. So you could see now where like every reinsurer and every insurance company just gets rebuilt, right? From first principles, the software is elegant. The underwriting and pricing seamlessly communicates with the capital needs and provisions the capital is kind of necessary on a just-in-time basis. All that stuff's going to happen, right? Like if you think about every friction you've ever encountered buying insurance, on the front end, it gets resolved. On the back end, all of it gets resolved. And it's just a matter. It's not a matter of if. It's now a matter of when. So that's how we think about the business moving forward over the course of the next couple of years.
I think that there's it's interesting as I've talked with folks, and you see that as a result of the Genius Act, and hopefully clarity comes, is that, you got the New York Stock Exchange allowing 24-hour trading of stocks now, not because they want to, it's because they have to. And you got new stable coins popping up all over the place. I saw one this morning. I forget what company it was, but I was like, wow, now this company has its own stable coin and it's being incorporated. So Jose, what are the vectors that you feel like are approaching this, like from a Rails perspective, kind of inevitability in the payment space? Like, how do you see things evolving? So what Karn's basically done is he's put together this, it's kind of like a multi-sided marketplace, because you need the regulators don't count as that. You have a regulator, then you have folks you have to underwrite, then you have this source of DeFi capital. When you put, a reinsurance policy on chain, like there's reasons why it's better to be on chain versus like a money market fund, right? If you can it's a new on-ramp for capital, number one. It can be used as a primitive in different, or as an asset in different types of DeFi use cases. Like, how are you seeing the payment space in general evolving here in terms of what's going to be happening very fast in the next 6 to 12 months? Like, which trains have left the station?
I think if you have any sort of experience with international money movement, cross-border transactions, you know that it's really just inefficient, slow, costly, and such. So really where stablecoins come into play from a payment standpoint is it's effectively better money, right? It settles 24/7. It doesn't have to depend on any other sort of counterparties or banks, and systems where, for years it just took too much time to move from one to another. The space where I'm seeing it evolve incredibly quickly with, say, corporates or these large enterprises is in treasury management. So being able to, pay your own entities, pay suppliers, go, send payments to say Africa or other parts of the world where now stablecoins make it so that they can do so at a much more cost-effective way and a much more speedier timeframe. So that plays into the insurance space, and really any sort of payment that consumers are making, leveraging really stablecoins on the back end, but on the front end really just using fiat to say send money to bank accounts, convert to stablecoin, settle much more quickly, and then on the back end with those banking connections, be able to pay those suppliers or those entities that you're trying to do cross-border payments with. That's really where I'm seeing a lot of traction, at least with these corporates and real businesses that are using not necessarily the tech, but the solutions that the tech brings along to make their businesses more effective.
And what do you see as the future of, is the future of stablecoins a couple of big ones that everybody uses? Is the future everyone has their own stablecoins that are interoperable and branded? How do you think this market is evolving right now? Is it going to be concentration, or I wouldn't even say fragmentation, because typically, you can have a degree of interoperability moving between these things. But how do you see this process moving?
Unfortunately, I do think that there's going to be a lot more fragmentation, but there will be some clear, I don't want to say winners, but those stable coins that will be more widely adopted. So, regulation comes into play, but, I see where these branded stable coins or these fragmented stable coins, where they can be efficient is within their own sort of like closed loop ecosystem for better efficiencies within the business. More widely spread, I would say, there's going to be a few stable coins that folks will gravitate to in order to do treasury management, cross-border payments, et cetera. I don't think that's where these branded stable coins are going to really come into play. I think it's a nice story to tell now, but the infrastructure really lies in those well collateralized and established stable coins that are out in the market today.
Yeah, and Ray, so obviously, if you're going to have the intersection of TradFi and DeFi, you have to get compliance right. So, what are you seeing in terms of how organizations need to work to incorporate all these primitives in a framework where they can actually operate? I guess is the question.
Yeah, I think you hit the nail on the head, David. And the intersection requiring this level of compliance is interesting. It's more of a thought experiment until it's not. It becomes a necessity. And I think what you outlined with New York Stock Exchange moving towards 24/7 tokenized incarnation of its equities business highlights the fact that we're moving towards where it's no longer an option, right? You go for a while not having a website in the early 2000s, but eventually that was kind of a dying breed. Unless you're like a niche hardware store somewhere in the Southeast, you kind of have to have a website. I think the key undercurrent that I see is this disintermediation narrative. We all want disintermediation when there's existing bureaucracy that's just insurmountable, just because it's just more efficient, cost effective, and serves the end consumer better, and ultimately makes for better capital formation. But there's some level of disintermediation or intermediation that's necessary. Like, for example, this stablecoin narrative, where we have tons of different issuers for various stablecoins. The common intermediary there is the dollar. We had situations where companies would issue script, and we had a lot of efficiencies there. Private companies issuing their own currency, largely in coal mining towns in like Appalachia, gave a lot of efficiency and economic flexibility, but there was huge amounts of downside because there was a primary issuer. You were beholden to that particular issuer and had very little recourse. So ultimately, this kind of, I guess you can call the edges between TradFi and DeFi, you're going to see huge amounts of disintermediation. But I think boiling it down to what is crucial to remain as an intermediary, which is the risk and compliance component, is essential. And that's what we're seeing now. Basically, a lot of folk who are in compliance and risk asking, how do we take our existing frameworks and fit it around this? And that's really where we come in. That's why there's no clear-cut answer. There's no, other than saying on the right side of the law, there's no objective way to implement this technology, which makes it really fun, right? It's kind of why we're all here.
Mm-hmm. So let's get more theoretical here. I can't wait. I'm so happy I can give this one to G, because this will be the hardest question. Other people will be able to think about their answers and just have to answer on the spot. So this is great. Why is it better to have real world assets on chain? It's not, we talked about this, right? Everyone points to these issuance metrics where it's just the amount that's been issued. Okay, well, great. So what? What's the next phase of why it's actually going to be better to tokenize assets at scale on chain? Because just the simple issuance is not all that interesting, in my opinion.
Look, I would agree. I mean, I'll give two answers. I think the second one's more interesting. The first answer is that you could almost look at it as like proof of concept, like in nature, when turtles hatch, like there's always one that goes out first. And if it doesn't get eaten, the rest follow, right? So it's like you could say, well, if XYZ fund, put $1 billion of their fund on chain and they felt comfortable doing it and nothing broke and nothing got hacked and all the fears that people may have who don't really follow the space that much, then it opens the door for other companies to build. So that's like very 30,000 feet. The second way I'd answer is that, we kind of think about this internally, building an L1 ecosystem, because L1s are obviously technology, but it's really the ecosystem that draws people, right? So you could almost think of it like building a city. This is an analogy we use, where if you come to a city and you say, oh, it's a great city, it's a beautiful city, you're going to love it here. There has to be stuff. There has to be buildings. There has to be parks. And so you need to, when you invite people into an ecosystem or projects, there needs to be something to buy, whether there's idle capital or there's a neobank. There needs to be things to purchase, to invest in, to stake on chain. So I do think that even if, upfront, no one is buying it day one, let's just say it's a PE fund, I've never clamored to buy a share of a PE fund. There's a million different things to invest in, right? In order to get some other company to invest, again, a neobank or whatever, there needs to be something that already there. You need to, when you seed an ecosystem, you have to start with one thing, then the other thing comes, and then the other, and you slowly build up both sides of the scale. So you can almost say this is almost like building the second thing first. You're building the supply before you necessarily have the demand, because if you have the demand and there's no supply, people just leave. Now, I do think over time, there will be a demand for it, because there's demand in the real world, and I think over the real world, Web 2 world, and there will be this real world assets. It's like, it's a funny term because it kind of implies that we're in the fake world, but in any case, I do think there will be, if there's demand in the quote unquote real world Web 2, whatever, there will then be a demand in Web 3, because everything seems to be moving to Web 3. Like David said, you can buy, the stock market will be 24/7, right? Eventually things will come our way, and the early adopters will probably be rewarded in some sense by just being the only game in town for the first year or so. So look, I do think it's important. I don't know if it's important day one. I don't think it gets users on board. I don't think there's a proven demand that there's for this stuff on a retail level, but I do think in terms of ecosystem building, you need to have some first movers, so that when there are larger projects and larger capital coming on chain, there's something to buy and there's a proof of concept.
So Karn, kind of same question. So I think that's a really good framework. So right now, USD Re, people can buy it. They can get a yield on part of the reinsurance revenue. Like 12 months from now, how do you see USD Re being used differently, if at all? I mean, will people be putting it into Aave and getting their 20% on the USD Re and borrowing against it and doing looping, or like how do you? Is that's where it gets interesting, right? Is the creation of new financial primitives or different ways to get leverage. So what does USD look like in a year?
I don't think I have like a thesis for broader RWAs, because I think a lot of them just don't have product market fit. Like they're not particularly unique assets. Why do you think that's the case? Yeah, so this is kind of the setup to why like something like Re is distinct, right?
Yeah.
It's an opaque market that very few people have access to. It's massive. It's usually the purview of sovereigns and pension funds that are funding most of this stuff. So these alternative capital markets aren't necessarily available. That's fine. I think you can kind of frame that as a thesis for like some subsection of RWAs. I just think it's better technology than exists for a business that needs to prove to the world that it has security collateral, right? Like the entire premise behind our business, and quite frankly, all of these L1s is like, put something at risk. If there's some future state of the world that is not as you expected it to be, you get slashed. Same thing, and there's an analogy here to be drawn. So I think of it as just a superior piece of technology to reflect exactly the economic sort of coordination and activity that's happening in the real world today. So whether or not that ends up being a DAU over MAU app, it's unlikely, but does it become something that's akin to a background process in the substrate that already exists in the real world? I think so, just in kind of in a more efficient way. And to your kind of illusion, like the technology can then work seamlessly with the rest of the technology everybody else is building, right? And so if you want to be able to borrow against your assets, specifically these assets, you can do that today. You can do that on Morpho, you can do Euler, on Silo, eventually it'll be on Aave. If you want to split out your contribution from projected future economics, you can do that on Pendle and other sorts of yield splitting platforms as of today. If you wanted to build on top of this thing, right, and integrate this and or find a way to include other risks over time, there's a possibility for that to happen, right, as part of a protocol, become an underwriter, submit risks. It's already happening, I think, continues to evolve. For me, it's really hard to project kind of how the general innovativeness and intuition that people are going to have around these products. I just came out and said, hey, this should exist, should work. It does work. It in many ways emulates what happens off chain, but in a much more seamless way, broadens access. And from where it goes from here is like really up to like the some capacity of human ingenuity, right? Like that's what makes this thing.
I'm going to put that on a banner in my office. No, but back to what you said at the start, though. So it sounds like you believe that certain RWAs with certain characteristics make a lot of sense to have on chain. So ones that require proving collateral, like what are the criteria that make sense and that are interesting? What are the criteria that makes an RWA interesting? I guess is the question.
Yeah, I think transparent. Like, I'm just going to kind of, because I have bias here, like transparency into an opaque market, lack of access to a specific market, things that don't necessarily correlate with what everything else is going on in crypto, in equities and fixed income markets. I'm literally describing our product to a T. So it's that's the kind of the bet I've made. But I think that like tokenizing a T-bill or tokenizing an equity is some accretive. I mean, those businesses don't make money, and ultimately, like that's going to be some sort of like transformation from the existing market to what happens, on chain. And most likely, the users are going to be AI agents that are coordinating economic activity amongst themselves, rather than people who are dealing with clunky infrastructure. And so, if you need verifiable asset movement, if you need everything else, and you need these things that will otherwise attempt to lie, cheat, and steal from one another, to be able to trust a substrate, I think that's where it becomes important. But again, it feels more like a background process than kind of a consumer application.
Okay, that's interesting. Yeah. So Jose, I want to focus on this metrics thing. So like, what are the metrics right now that people care about in terms of RWA with respect to payments? And what are people caring about the right metrics, and how are the metrics that people looking at likely to change? Like if we see more adoption happening, with on-chain payments, and that's reflected with more assets being involved in the process, or maybe different types of assets, like how are people currently talking about it, and what are they missing? Is I guess my question.
My answer, I'll say, is I think that folks have maybe been focused a little too much on what I would call the vanity metrics, right? Which is, how much volume are we seeing in terms of like on specific to payments, right? Like how much volume are we seeing? How much money has actually moved? How much stablecoin transfers have we seen? When it comes back to growing the Avalanche ecosystem, really what I'm more interested in is number of transactions. How many transactions are we seeing on chain? That really brings a lot more economic value back to the ecosystem. So in terms of like the numbers, like how many what's the market cap in stable coins on Avalanche, for example? Like I'm less interested in that. I'm actually looking at where's the real economic activity happening, where are the number of transactions, where are these stablecoin transfers happening, and that differs by use case, of course, whether that's peer-to-peer payments transactions or say treasury management transactions where you're going to see a lot less transactions. But really what I'm trying to do is go out and talk to these teams and provide real solutions to these problems that they're trying to solve, not necessarily talking about the blockchain or the technology, but taking a look at how we can create efficiencies compared to the existing payments rails that they currently have. So long way to say that on-chain transactions, regardless of the volumes that we're seeing, is a lot more interesting to me, and I think that's where people should really pay attention to. And we've seen spikes there as of recently. There's a lot more stablecoin volume going back and forth, specifically transactions, regardless of the use case. So that's where my interests lie, at least from our perspective, as we look to grow the Avalanche ecosystem.
And Karn mentioned agentic payments or agentic movement of value. Like, how far off are we from seeing that? Or like, are people talking about this that a lot that you interact with? What's your prediction for when this actually starts to pump, or when we see, I guess, early indications that this is happening at some at least early degree of scale?
I'd say we're early, right? I think the tech is amazing. I'm watching it very closely, but when it comes to demand, I just don't see that there's enough, say, retail or merchant payment activity when it comes to AI or agentic payments at this point. Come to me in 3 to 5 years, and I'd say it's going to look very, very different. I would anticipate that it's going to blow up as you mentioned, or really start pumping in about that time frame, once there's more of an understanding of what even like agent to agent payments or agent to agent transactions actually mean for the greater sort of retail or average. I don't know if consumer is the right word, but we're at the point where I just don't think that we have enough demand for it to really pop just yet. But I do think that it will. Give it 3 to 5 years.
And do you think that'll happen at the consumer level, or do you think that the way that this happens is through, folks who either own the front end or operate the back end plumbing, like Karn, just decide that it's a better way to run the back end? So what are the vectors of demand likely to come from initially, in your perspective?
I'd say the latter. I guess. No, it's not going to come necessarily from your consumers or your retail, at least not yet. We're first going to see it from those folks kind of building the infrastructure to build these efficiencies and better ways of transacting for, things like compute and, APIs and things that agents can, make these micropayments with stablecoins and do it in a much more efficient way.
And Ray, this obviously creates this agentic payments. You say people are struggling with the stuff right now with more basic stuff like stable coins. Like, how long will it take for, like, what's it going to take for regulated institutions to be able to operate like this? I think this may be more a general question. It can be both on chain and just more generally. But there's obviously different risks and different opportunities if you have agents running financial value. So what are you seeing in your conversations with folks? Is this topic coming up at all?
It's not even coming up yet, and frankly, I'm worried, David, because I feel like I'm kind of cooked already. I tried to use OpenClaw, and I want to get a T-shirt that says I spent the equivalent of a Mac Mini in API costs, and all I got was this T-shirt. It's a cool tech, so it's currently relegated to just the Galaxy brains out there who know how to make it work. But once that dam breaks, to Jose's point, and your tech literate folks such as myself who can work their way around a computer and a system but aren't super deep tech can use it, that's going to be wild, because you're going to have a similar kind of flow of conversations we're having now. Like, hey, we have these smart contract architectures and ERCs. What does what? What's coming on chain? Give us a finger on the pulse. Only it's going to be more esoteric with higher velocity. And how do you regulate an agent? Like, it doesn't have a passport, it doesn't have a citizenship. So it's coming up as like, oh, this is a neat thing, kind of like super early internet. But I think it's going to be the second kind of tidal wave that just like hits the compliance and risk teams, and they're just not going to know what to do. How do you handle this stuff? It's brand new.
I mean, G, is there going to be a distinction between TradFi and DeFi in 5 years? I mean, I'll ask everyone around the room, like, isn't this like, this is my question, or is this going to be like, you know, if you think about a bank or your way to take a loan from a bank, it's just a financial primitive, the same way I take a loan out from Aave, it's just a different counterparty.
Yeah.
Like, we have this on-chain economy, we have the off-chain economy, but there's this convergence on the tech stack. So is there, will there, in 5 years, will we talk, I guess my son will have his, you know, bar mitzvah in 5 years. Will we have a difference between DeFi and TradFi here?
Yeah, that's a good question. Yeah, you'll be getting airdrops instead of envelopes, you know.
Yeah, that's right. Exactly. They'll just give them the wallet address out.
Yeah, exactly. Yeah, I think that's the thing. It's like there's kind of analogs, right? Like your bank account could be a wallet, like, and a lot of them are already. So it's I do think there's Web3 in a lot of ways is just a better way to do it. So I think there will be, I don't know if it's convergence, but I think TradFi will find its way to Web3 in the sense that, in theory, in a free market, if the early adopters prove that their offerings are better, well, then every other bank or whatever the provider is needs to catch up, or else they'll just have an inferior offering. So, you know, maybe the first mover runs into some issues and it takes a lot of work out the kinks. But yeah, I do think eventually, because Web3 rails are better for, I mean, virtually everything financial. I do think that there will be, yeah, I do think there will be this kind of move on to those rails. But importantly, I think new nomenclature's needed. I think, you know, a lot of these terms, wallets, you know, like they're not super intuitive to people. And I also think they'll need to be hidden in the back end. But, you know, everything is already hidden in the back end. When someone sends money on Venmo, they don't know what's happening. They have no idea, you know, like, and that's fine. It's kind of the way it should be. And people don't know how Wi-Fi works either, and they use Wi-Fi every day. So I don't think really that's the problem. I think the problem is getting the infrastructure set up and then just presenting the outcome to people, which is really all we ever know anyway. When I hit this button, money goes from my account to somebody else's. When I click this button, I get 3% yield. You know, and Web3 already has most of that. It's just sort of like hard to navigate because you have browser plugins and wallet address. It's not a person's name or a bank account. It's like this alphanumeric sequence that if I get one thing wrong on, the money disappears and I have no one to customer
My
service.
hand sweats every time I send stuff. I've sent thousands and thousands of transactions.
Oh, I know. I mean, listen, I've heard stories even from the biggest Web3 custodians. Their experience is the same as yours or mine. Like, there's no level at this of expertise or money where or you know, notional value where it gets easier. It is a, you know, that you're sending, you know, let's say Bitcoin, where there's a little bit of a lag because of the block time. I mean, that, you know, 5-minute, 10-minute window, you're just like, you're sweating, and there's no one has a solution yet for that sort of thing. Now, again, we'll get there, and Bitcoin is its own beast, but, you know, those are the things that have to be worked out. But over time, I mean, you look at the early internet, anything, like, it takes a while till you get to the place you ultimately end up at.
Yeah, Karn, same question. I think you kind of alluded to this, so I think I already know what your answer is going to be. But, you know, in your business, in 5 years or whatever, is there going to be even a distinction here, or is there just whatever the rails that work best are the ones that become the default rails? Or I guess reinsurance is a very slow-moving industry, so maybe it won't happen in 5 years. But
yeah, look,
this distinction.
It's a $1 trillion market. And then there's 7 trillion in primary insurance. I think it's going to take a little while.
Yeah.
You know, we've had self-driving cars here in San Francisco for 6 years. They haven't started to proliferate across the United States as of yet. So there's always a latency in adoption. And you know, individual economic interests trump global economic interests at every part of the value chain, and that's something that needs to break, or and it really just takes time to break. So do I expect DeFi to subsume all of reinsurance in 5 years? Probably not, but it will have taken a big chunk out of it, and we're talking about really like self-driving cars versus combustion vehicles, something like that.
So it's still like, in this case, it's still driving, and in this case, it's still reinsurance. It's just reinsurance being done in a slightly different way. And, whether it's DeFi or whether there's a big RWA marketplace where hedge funds can put the money in, you don't really care, right? It's just how do you get money coming into the engine so that you can underwrite more reinsurance business. So
yeah.
When we say DeFi, it's like for right now, DeFi for me feels like people operating or moving value on chain. If there's a lot more people moving value on chain, there's nothing that's decentralized necessarily about how you're doing your reinsurance business. Is you're taking capital in from a certain type of way. So that's interesting for me. If there's more people able to operate on chain with capital, is that still DeFi? Is it just better rails not enabling financial access? Is that still DeFi? Do we need to have that distinction? That's what I think is kind of interesting about this.
Yeah, I mean, Giancarlo kind of pointed this out. It's the result that matters, right? Like if you think about buying insurance, if you're a CFO or you run a business somewhere, in an ideal world, you have some sort of Einstein superintelligence advisor that understands your business and the exposures of your business, crafts bespoke insurance coverage, and provisions the capital on chain to provide the backing for that insurance coverage atomically, right? Like you don't need all the other infrastructure. Is that 5 years out? It may be more like a decade out. But you've cut an incredible amount of cost and friction out of that process, and now you've moved from something that's kind of episodic to much more of a live system with respect to like risk management, right? There's an end state that everyone has in mind. I think you just got to like chip away at it. Yeah.
Got it. Jose, kind of same question. Like right now we have Web 2 payments and Web 3 payments. How long is this distinction likely to last? Because I think, as G rightly said, like I don't know really how my car operates. I don't know how my heater system operates. I certainly don't know how. I kind of have some idea about how the cloud services operate that I use, but not really.
There'll be a convergence. I think, like I agree with everything that everyone was just saying, in that the results matter, right? In order for there to be this adoption that we're looking for. But I do think that we'll get to a point where folks will send quote unquote stable coins without knowing that they're sending stable coins. They're just sending money. It's better money. I put a post out there recently around the fact that I feel like the term stablecoin is almost outdated because really we came up with it at a time where the word stablecoin was because everything else in crypto was unstable. That's no longer the case. I'm not saying we need better branding in order for it to eventually converge so that, it's, working behind the scenes. It will take some time. But, how consumers sort of, look at, stable coins or the space that we're in, really will disappear. And eventually it'll just be a convergence of Web 2 versus Web 3 payments. I don't think there will be a distinction of Web 2 and Web 3. It'll just be better money for better businesses.
Same. Anything to add on this, Ray?
Yeah, I agree wholeheartedly with this thesis. I actually kind of have the lived experience version. My grandmother, she since passed away, and she was in her 80s, but she didn't like the internet. I don't know why. She probably just heard like something in the 90s. It was like the internet. It's like a microwave. It'll give you radiation. She was like, well, don't want that. And then as she got into her early 80s, like we got her a debit card finally, and it just blew her away. She's like, oh, I don't have to carry cash, because a small Italian woman carrying a giant wad of cash, not a good idea. And we never told her it was the internet in the background, but she loved it. She was like, why have I not been using this sooner? This is awesome. So I love to use the grandma example. If I have to say, okay, grandma, you're going to send USDC. No, not that USDC. No, make sure that's a 0 and not an O. Okay, that's good. Like that's not going to make it. So fully agree with Jose. We'll see the convergence. We just have to solve the raise grandma problem, essentially, which is the late adopters.
Yeah, I mean, I think that we've all been, sitting on the sidelines with our pom-poms saying, yeah, Web3 Rails, Web3 Rails. It's interesting to me that what it really took was regulation, which is not surprising because in the beginning days of the internet, people would say, oh, you're trying to monetize the internet. How could you do that? I mean, these were conversations that were happening at the beginning of the internet. So regulation, I think, continues to make a massive difference here. And if clarity is passed, I think that's going to accelerate the process even more because it can't just be the best technology or a better outcome. You have to have the large sources of capital and the large institutions be able to access it. And I think that's what fundamentally has changed is I think everyone here is saying that it's better outcomes that matter and better outcomes tend to win the day. And I think that there are substantial tailwinds around those better outcomes, which will make people who adopt the technology do better and people who do not adopt the technology do substantially worse. That's why I thought this thing with the New York Stock Exchange was super fascinating because the only way and reason why they would do this is because they thought that they had to maintain share in the face of activity from folks like Robinhood or Kraken or Coinbase who allow anyone to trade stocks 24/7 now. So this has just become in a very short period of time, like probably in the last couple of months, an industry norm and shifted fundamentally a system that's completely inefficient. And why can I only trade in normal business hours? It's probably just because the folks who are monetizing it, it's better for them. We got 5 minutes left. I'm going to ask, we didn't get really into this. So I think we really covered the first dimension here is, why are the Rails better? And if we think about having RWAs on chain and the intersection of DeFi and TradFi, the various vectors that would get us there. So there's new asset classes, as Karn has talked about. So asset classes that are fundamentally better to have on chain because of access or transparency reasons. I think that the stuff that Jose has talked about, that fundamentally, when you look at payment rails, it's just substantially better if you're doing a cross-border transaction, not to have to go through a correspondent bank. I mean, I don't know if everyone's ever done this. I tried to send $10,000 to New Zealand. It took a week to get there and had to hop through 3 different banks. I mean, that makes no sense. Why do we need that? So there are some forces that are moving this in a very positive direction. In any type of technological shift, you basically want to help people save money or make money. Those are the 2 primary drivers of, I think, any type of a business if you look at it as core. And I think if you look at the evolution of the Web3 tech stack, the DeFi was very much out of vogue for a number of years post FTX. And I think it's interesting for me that everything is kind of swung very much back to the financialization aspect of running things on chain. And I think that is very interesting because, and this is the direction kind of Avalanche has taken with this embedded finance stack, is if you provide businesses with an integrated set of capabilities, which allows them to either make money or save money, it's economically rational to then run on a settlement layer that provides for assets, especially the sense that it is there, that it has been used in a certain type of way. But it's not just in the context of having the asset live on chain. It's that allows somebody to run a better business on chain. And I think this is one major part of the equation. I think the next call we'll talk about the other part of the equation I think is very interesting here, which is tokens as a capital formation vehicle and how those might be better or worse than equities. I think that there haven't been a lot of entrepreneurs like Karn who are building operating businesses and thinking about attaching a token to them as a complement or an alternative to traditional equity markets. So I think if you view a token as a capital formation vehicle, which in fact it is, it's just that lots of capital has been created that's been wasted so far because it hasn't been allocated around an operating business, then I think that this gets even more interesting and there's the ability to build even better on-chain economies. So within Fusion, as we've talked about before, That's what we're focused on here. It's it's a series of vertical ecosystems that are basically trying to create real world outcomes for users and their real businesses. We made the decision a couple of years ago not to work on stuff that didn't have fundamentals within this ecosystem, and to really build this around a different set of principles. I think we've talked about this before, working with the best possible people, not all people, because unfortunately or realistically, not everybody can be the best. That's just how a bell curve works. And we want to use blockchains for what they're good for. And I think that the people on the call today highlighted a lot of reasons why it would be economically rational to build a business around these principles and around this technological stack. So I expect that this will continue to accelerate. Folks who have listened on the series, we tend to talk about these serious topics because these are the topics that matter. If there's going to be a technology stack which fundamentally changes the economic profiles of companies and of industries, it does start with the building blocks. And I think that we have, for far too long within this industry, focused on the wrong things, e.g. short-term outcomes at the expense of longer-term sustainability. But the good news is that from a regulatory perspective and a technological perspective, I think there are strong tailwinds. So let all the tourists exit. As I said before, that's fantastic. Everybody who wants to stick around, I think it's just getting more and more interesting if you look at what's happening from a fundamental basis. So with that, I wanted to thank everybody for attending the Fusion X Spaces. Thanks to all the panelists. Appreciate your time. We'll be back here in 2 weeks. The topic's going to be tokens versus equities. How are they different? What's the advantages of one versus another? And if you're going to launch a token, what should the point of that token actually be? So with that, thanks a lot. We will shut down the spaces and see you next time.
Thanks so much for the time. Cheers.